You know that feeling, right? That pit in your stomach when you open your investment app and just see a sea of red, minus this, minus that, and every single headline is screaming about recessions and market crashes. It's totally natural to want to just sell everything and run for the hills. But what if I told you that exact feeling of panic is actually hiding a massive, once-in-a-decade opportunity? So let's get right into it. When the market is tanking, you really only have a few choices. Do you give in to the panic? Do you sell and lock in your losses? Or is this the exact moment that can make you rich? We're going to break down exactly how you can turn that fear into a clear-headed strategy for building some serious wealth. Okay, first things first. To beat the fear, you've got to understand what's causing it in the first place. So we're going to pull back the curtain and look at the real reasons markets crash. Because once you know the why, you can make smart, calm decisions while everyone else is running around with their hair on fire. When you really look at it, big crashes almost always boil down to one of three things. You've got bubbles bursting, you've got major economic downturns, and then you have the complete out-of-the-blue surprises, what we call black swan events. Let's dig into each one. So what even is a bubble? Well, just imagine a stock's price getting pumped up by nothing but pure hype. It has nothing to do with the company actually making more money. People just get swept up in the excitement, they pile in, and the price goes to the moon, way beyond what it's actually worth. But hype never lasts, and when reality finally sets in, the whole thing comes crashing down. And this can get wildly extreme. Just look at the dot-com bubble. The internet was this shiny new thing, and investors were literally throwing money at any company with a .com in its name. The Nasdaq index shot up an insane 800%. But then people started asking, wait, are any of these companies making money? The answer for most was no. And boom, it crashed by almost 80%. Hype goes up, reality comes down. The second big one is just the overall health of the economy. When stuff like inflation gets really high, you feel it, right? Everything gets more expensive, so people spend less, which means companies earn less. Then, to fight that inflation, central banks raise interest rates, making it harder for those same companies to grow. It's a chain reaction that can lead straight to a recession, and a falling stock market usually follows right behind. And then you have the black swans. These are the totally unexpected, out-of-nowhere events. The COVID-19 pandemic is a perfect recent example. In February 2020, the market was hitting all-time highs. Just 1 month later, as the entire world was shutting down, it had plunged over 30%. These things cause instant panic, precisely because no one, and I mean no one, sees them coming. So, with all these terrifying things that can cause a crash, you're probably wondering, is any of this normal? And the answer, which might actually surprise you, is yes. 100%. Historically, these downturns aren't just normal. They are an expected, regular part of how the market works. Let's just look at the data. These little drops, we call them pullbacks, they happen pretty much every single year. Bigger corrections of 10 to 20%, you can expect one of those every couple of years. And yet, even the really painful bear markets and full-on crashes happen on a pretty regular cycle. So you see, they aren't some crazy exception to the rule. They are the rule. And this right here, this is the most important part of this whole explainer. The market always comes back. Always. After the '87 crash, it was back on its feet in 2 years. After the huge 2008 financial crisis, it took about 4 years. And after that shocking COVID crash, just 4 months. The pattern could not be clearer. Markets fall, but for investors who are patient, they always rise again. And usually, they end up even stronger than before. Okay, so if crashes are normal and the market always recovers, why do so many people lose so much money? It's actually pretty simple. They make predictable mistakes driven by emotion. Let's walk through the 5 most common ways that fear can absolutely destroy your financial future. So here are the big ones: selling everything in a sheer panic, trying to be a hero and perfectly predict the absolute lowest point, buying truly awful companies just because their stock looks cheap, putting all your eggs in one basket, and of course, just blindly following the panicked crowd off a cliff. But listen, for every single one of these mistakes, there's a much smarter play. All right, this is where we flip the script. This is how you take that moment of maximum fear and turn it into the single greatest opportunity you might ever have to build long-term wealth. Let's get into the actual strategies, starting with how to avoid the biggest mistake of them all. The number one absolute worst mistake is panic selling. But you need a mental shift here. That big negative number in your account, it's just a paper loss. You haven't actually lost a single penny until you physically hit that sell button. The smart move, if you own good companies, is to just stay calm, stay informed, and keep your eyes on the long-term prize. The next trap is trying to perfectly time the bottom. Trust me, it's a fool's errand. It's basically impossible. A way smarter strategy is something called dollar cost averaging. All it means is you invest the same amount of money on a regular schedule, say every month. When prices are low, your money automatically buys you more shares. When they're high, it buys fewer. It's an automatic, completely stress-free way to benefit from downturns. Now, this one is so important. A market crash puts everything on sale, right? But that does not mean everything is a good deal. The mistake is buying a garbage company just because its stock is cheap. The real opportunity is buying fantastic companies, the ones that are profitable, have low debt, and a strong business, when their stock is on sale because of the panic. Let me make this crystal clear with an example you'll definitely know. Amazon. So back before the 2008 financial crisis, it was already a powerhouse, and the stock was trading for about $90 a share. Then, the entire global financial system almost collapsed, and the whole market crashed, taking Amazon down with it. Panic was everywhere, and the stock got chopped by more than half, dipping below $40. But here's the key. Amazon, the business, was still great. It was just on a massive once-in-a-lifetime discount. And for the investors who saw that for what it was, a great company on sale, and had the courage to buy, well, the reward was just staggering. By 2021, that same share of stock was worth over $3,000. That is the power of buying quality when everyone else is scared. Another classic mistake is putting all your money into just one stock or one industry. That's playing with fire. The smart strategy is to diversify. You spread your money across different areas. A super easy way to do this is with ETFs or index funds, which are basically just pre-made baskets that hold hundreds or even thousands of different stocks for you. It's an instant safety net. And finally, you have got to resist following the herd. When everyone is panicking and selling, that's herd behavior. Smart investors do the opposite. They do their own research. They actually understand the businesses they're investing in, and they have the courage to act based on logic, not on what the scared crowd is doing. Really? It all boils down to this incredibly powerful piece of advice from the legend himself, Warren Buffett. Never invest in something you don't understand. If you know why you own a stock, you won't get scared into selling it at the worst possible time. So, the next time the market takes a nosedive, and it will, and all the headlines are predicting the end of the world, you're going to face a choice. Will you be fearful like everyone else and sell at a loss, or will you be ready? You'll be informed, and as Buffett would say, you'll be just a little bit greedy when others are fearful. The choice now is yours.